In terms of typical impact of elections on markets, regardless of the winning party, markets have often historically rallied, at least for a time post-election, likely because investors dislike ambiguity, and so more clarity as a result of knowing the election outcome is often rewarded with higher returns, at least temporarily. The extent and persistence of any post-election rally depends on a number of factors. At this time, the presidential race is essentially a toss-up, and divided government is the most likely outcome. That makes wide-ranging policy initiatives difficult to enact and suggests higher market uncertainty and volatility on average. If this outcome shifts to a Republican or Democrat sweep, then more leeway for substantive policy change can lead to different outcomes for markets. So definitely important to focus on policy similarities and differences. The US government is expected to continue its efforts to curtail the growth of China's technological capabilities and also to seek to reduce US economic exposure to China, regardless of who wins the election. You can see that consensus across the political parties by the fact that the Biden administration did not roll back Trump-China tariffs, but in fact has increased them over recent years. Going forward, tariff policy potentially will be very different under the two candidates, with potentially much higher and much broader tariff policy under a second Trump term. More tariffs would equal negative implications for growth in both the US and the global economy, and potentially higher inflation and therefore higher interest rates. The Trump 2017 taxes are up for renewal in 2025 and will likely be renewed whoever wins the presidential election. But under a second Trump administration, all of the tax cuts, personal and corporation, will be renewed and potentially added to. We will likely also see some additional tax cuts at a time when it's not obvious that that's what the US economy needs. Under a Harris administration, only tax cuts that apply to individuals with income below $400,000 a year will likely be renewed, and they'll partly be funded with tax increases on wealthier consumers and on corporations. But in either case, there doesn't seem to be a desire or an ability to significantly correct the debt path the US economy is on. A Trump administration would focus on deregulation, which might be advantageous to specific industries or sectors, while adversely affecting others. A Harris administration would be focused more on additional regulation. Under a second Trump administration, in the short term, equity investors would likely welcome more deregulation, embrace further corporate tax reduction. However, more fiscal easing, more debt increase than currently expected, as well as a likely increase in the risk of a broad trade conflict, would be a significant concern for market participants. Stay invested and focused on long-term goals. Anxiety over possible policy changes might drive investors to make hurried investment decisions or to try and time their market participation. Historically, this has not been a good decision. Staying invested in a well-diversified portfolio through short-term volatility, whatever the source, has traditionally paid off. Overall, the longer-term performance of markets is not much impacted by whatever the election outcome. Much more important is Federal Reserve policy, the pace of technological innovation, and the strength of growth in the underlying economy.